Hello everybody and welcome to our next webinar on listed private credit. My name is Michel from LPX. Before I start with the actual webinar, I would like to give you a short introduction to LPX and to the asset class, and then give you an overview of listed private credit and the current trends and what we expect for the next 12 months. If we look at the different asset classes, we categorize private credit between real assets and stocks, and the reason why we put it here and here why you see an overlap to stocks is because we focus on listed private credit companies, so companies that are listed on the stock exchange and provide credits or loans to unquoted companies. But the companies, let's say the investment companies or loan providing companies are listed on the stock exchange. That's why is there an overlap, and that's also our niche focus. We focus exclusively on those type of companies. We also analyze private equity companies. That's not part of our current webinar, but I would like to mention this anyway, because there's also an interesting niche asset class. And as you can see here, also here, there's an overlap to stocks because again, we focus only on listed private equity companies. You see here 3 examples of benchmarks indices that we calculate and analyze. We have a private equity index, the LPX listed private equity index series, we have infrastructure index series, and we have a listed private credit index series, which measures the performance of private credit companies that are listed on the stock exchange. And when you have a look at the growth of that asset class, I think everybody knows it's an interesting and growing asset class. We expect this year more than 1.5 or close to 1.5 trillion of assets under management in private debt in total. But now let's start analyzing listed private credit companies. We started analyzing this asset class a couple of years ago. As you can see here, we are still talking about a niche class. 2009, we had less than 10 billions of market cap, so it wouldn't have made any sense to start analyzing or to compose benchmarks at that time. Currently, we have more than 80 billion of market cap, roughly 45 companies. We expect more companies to list in the coming years because it's a growing asset class and because investors are looking for yield, and this niche class is still offering very attractive yields, as you can see later on. So we started 2017-18 analyzing that asset class because we realized, well, there are a growing number of companies that are listed on the stock exchange, so it makes sense to start researching them and to compose and construct indices and provide that benchmark to others, to asset managers that can use that data as underlying for financial products. The yield, as I already mentioned, is attractive right now. End of April, end of last month, the yield was around 10%. This is especially attractive when you compare this to corporate high yields, to leveraged loans, and also over the past years, as you can see on the left-hand side of the slide, listed private credit showed a higher yield almost in all of the cases compared to leveraged loan indices or corporate high yield indices. So it's an attractive asset class, and investors can expect here attractive risk and return menu for their investment. There's also no duration in the portfolios because typically the contracts are made in a way that they are linked to a LIBOR or software index. So there is no duration in the portfolio, which makes it kind of interesting, and there is no risk in the portfolio of rising or lower interest rates. One interesting example is Oaktree specialty lending. That's part also of the index. On the right-hand side, you see the stock price performance over the past 10 years. You see some of the top investments, and that, as you can see, are loans. That's also something that we track. So for every company that's part of our index, we track the loan portfolio. We know exactly to which company the loan was given. We know the interest rate. We know in which sector that company operates, we know the collateral and so on. So we have the full look through of the loan portfolio. And this is also one of the advantages of listed private credit, because the companies are listed on the stock exchange. It is possible for us to analyze that and to get all the information on the loan portfolio that you can get. So in the end, it's a very transparent look through and database that we use, first of all, to construct and compose the indices, but that information is also made available to our clients that need data on listed private credit in general. Now let's have a look on how we construct that index. So we start with a set of companies, roughly 500 companies globally, which we classified as listed alternatives. This includes private equity, this includes infrastructure and private credit. So starting from that base universe, we first of all have to filter out those companies that provide private credits or provide loans to unquoted companies and are listed on the stock exchange. This is the starting point, and then we do a liquidity analysis, which means we analyze how liquid are those stocks. So we look at the bid-ask spread, at the trading volume, the market cap. We have then an index guide where you could look up all the criteria and then compose and calculate the indices according to industry standards, and then have all LPX listed private credit index. So that's a straightforward process. Everybody in theory could replicate that. But what makes us different is that we then also analyze the underlying credit portfolio in order to give also more information on the investments and on the investment characteristics also. But before we have a look on that, I would like to show you the performance of the listed private credit index over the past 15 years. And you see here two lines. You see one line which includes dividend payments, and you see one line, the lower line, which excludes dividend payments. And I show this because it's very interesting to see that the main performance driver, or the only performance driver in the end, are dividend payments, because excluding dividends, as you can see here, gives you or leaves you with almost no return over 15 years. So the main performance driver are dividends. However, those dividends are mainly driven by interest rate payments from the companies that receives those loans from the investment companies. So economically, we have a loan and yield portfolio. Legally, we are talking about stocks. But as you can see here, and I like this chart very much because it really shows the performance driver, which drives the performance of those listed private credit companies. So that's something I think what most investors are interested in is the dividend yield. And as you can see here, the dividend yield over the past 15 years was always between a little bit more than 7% and almost 11%. So it's very attractive. 10% is maybe a little bit higher than you would expect. I'm always saying, well, between 8 and 10% is something you can expect from that asset class as a annual dividend yield. But it's interesting to see that, again, this is the main performance driver and is really driving the stock price or the total return stock price of those stocks. Interesting is also when we have a look at the premium and discount level. So what we are also able to do is, because we do the underlying fundamental research and do the look through, we are also able to calculate a so-called NAV for each portfolio and compare that NAV with the stock price. And as you can see here, typically those companies tend to trade around 0%. So there are times when there's a premium, there are times where there's a discount. During COVID, we have seen a very sharp discount in that portfolio. Currently, we are trading at a discount of around 10%, which is, to be honest, it's an interesting entry point still. But yeah, as you can see here, they tend to trade around 0% premium discount. And this is also something we analyze on a daily basis and give that information to our clients. As mentioned at the beginning, there is no duration. There's almost no duration. So there is some fixed rates you will find in the portfolio, but over 90% is floating. When we look at the loan types, around 90% are secured loans. So we talk mainly about secured loans in that portfolio here. And when we have a look at the industry breakdown, we see here we have a very diversified breakdown over various industries. Over 80% are senior debt loans. So that's also gives some more security when it comes to the characteristics of the loans. And at the end of the presentation, I would like to show you two statistics. And because this is something we currently get a lot of questions also from clients, the so-called pick the payment in kind. And we relate this to the interest income to give you a feeling of how this involves and how this relates to the total or to the interest income, which is the most important income of those private credit companies. And as you can see here, this is roughly between 5 and 10% maximum of payment in kinds to the interest income. But as you can see also during the first quarter, it dropped again to a level of roughly 8.2%. But it's something we are analyzing on a regular basis because it's an interesting information and important information. And investors would like to know whether this ratio is changing significantly or not. A second ratio that we're also analyzing is the so-called non-accrual rate, that are loans where interest rate payments has been stopped. They are booked separately in the account, and also here it is interesting to analyze how those non-accrual rates have developed over the past years, because the number itself, it's around 1%. That doesn't give you a lot of information. However, when you see this, how this evolves over the past years, especially the last 2 years, we didn't see a sharp increase in that number. So also here we don't expect that there will be any problems arising from the loan portfolio. So again, this is important information, especially when you would like to know how are the credits, how are the loan portfolios evolving, and what can you expect over the next years. And especially when you have a look at the dividend yield, which is currently around 10%, whether this attractive yield is or has increased over the past years due to rising risks in the interest rate portfolios or not. But what we can currently say that we don't see rising risks in the portfolio. For some companies that might be the case, but on a diversified level, we don't see any issues right here. So now I'm at the end of the presentation. Thank you very much for your attention. Some summary points here, but in case you have some more questions, feel free to contacting me directly, and I will look forward to the next webinar. Then it will be on private equity. Thank you very much.